Welcome to Market Domination. I'm Julie Hyman. Josh Schaefer back in for Josh Lipton today, live from our New York City headquarters. We got 1 hour to go until the market close, and so we're taking a look at the major averages here that have been attempting a comeback today.
Yes.
But they're not quite making it there. As we talked about yesterday, there was they've been attempting an extension of yesterday's comeback.
Right.
I guess is the way I should put it. Because yesterday, of course, we saw that increase in the wake of the Federal Reserve comments.
Yep.
We were a little bit baffled by that gain and the magnitude of that gain, but they're having trouble hanging on to it today. Right now, the S&P 500 is down 1/3%. The Dow is off by about 23 points, but it was higher for some of the day, and the NASDAQ is down 0.5%.
Well, Julian, I think a lot of the strategists we spoke to yesterday essentially said, okay, we got through the Fed, but what really changed about the story here, right? If you want to look at just simply what markets were expecting, we went into the meeting expecting 2 interest rate cuts this year. We came out of the meeting expecting 2 interest rate cuts this year. Chair Powell largely just kind of gave a shoulder shrug to the tariff story and was like, we don't really know.
Right.
Welcome to the club. None of us really know, right? So I don't think we learned a whole lot from that perspective. And then the final point is, I don't really think the Fed was a large part of the narrative on the way down here, right? When we talk about the 10% drawdown that we saw in the S&P 500, if the Fed wasn't a large part of that story on the way down, is that really going to be the catalyst that brings us back if they're not really changing their tone at all? I don't know. It just seems like that's not quite what people expect at this point.
Yeah, so now we have this sort of muddling along that might continue, and we're going to talk about this with the strategists today, might continue through early April when the next tariff deadline is coming up quickly here. Just a couple other things to check on here. If we look at the 10-year, yesterday we saw a little bit move downward. We're continuing that, but it's small, 4.23%. In that, if you look around at some other asset classes, you've got crude oil that is coming back up. It's still below $70 a barrel. So sort of, again, this sort of maybe muddling along. And then large cap tech continues to be in focus, of course, and mostly still seeing selling there.
Yeah, and a lot of these stocks were significantly higher earlier in the session, right? At one point today, if we just look at Meta alone, Meta was up 4% at one point today. And it seems like people are starting to nibble into these stocks that have been sold off, right, that have been doing well, but no one's really staying in them on a consistent basis, right? It feels like every rally we get, it's okay, here comes the rally, maybe people are starting to buy back into these names, and then you just sort of glide down, right? And so that's not quite what the mood has been in this market right now.
Right, and just to give another example of this, I know Tesla is not exactly typical of really anything at this point, but if you go in the past, let's say, 2 weeks or so, right? You get a little bit of buying met with selling, a little bit of sideways met with selling, a little bit of buying met with selling. I mean, it's been the rare 2 days that you've seen the stock go up, certainly, but even in the same direction. There's just been a lot of bouncing back and forth, but obviously the trend overall is to the downside.
Yes, well, especially with a stock like Tesla, right? But I think largely, we talk about that momentum trade unwinding. It just feels like we're not able to get a grip back on momentum and start gaining.
No, we are not. And then just was going to do a quick check on the sectors as well today. You got tech, as we looked at, doing the worst today, materials as well, although energy stocks are trading a little bit higher today. Well, for more on the markets, as stocks look to try to build on Wednesday's Fed-fueled gains, let's welcome in Michael Kantrowitz, Piper Sandler Chief Investment Strategist. Mike, it's always great to see you. As we're looking at this market sort of muddling along here, we keep trying to figure out what is going to end that, right? What is the thing that is going to break stocks out of this malaise? What's your best guess?
Well, I think there's just growing uncertainty, and we're somewhat in a negative feedback loop because the uncertainty that began with tariffs has now spilled over into soft economic data, and it's now spilled over yesterday to greater uncertainty among the Fed's expectations. So it's hit Fed policy and created uncertainty there. And in a few weeks, we'll also see earnings uncertainty. So you got to go back to the initial catalyst that's creating all of this or driving all of this, and it's uncertainty about tariffs. And until we get to April 2nd, we're kind of sitting and waiting for some direction and for some clarity, and we're going to get a lot of news then.
And Michael, I'm curious, I know you talk a lot about sort of a correction doesn't come out of nowhere, right? We can talk about valuations being high, but you need that catalyst. You mentioned it was kind of policy uncertainty that kicked that off for us, right? Fiscal policy uncertainty. Does it need to be the same catalyst from the bottom too, or can it be a different sort of catalyst that brings us off that bottom?
Yeah, it usually is. If you think, just think back in recent periods, or take the last period of policy uncertainty that pushed the market down. It was the fourth quarter of 2018 when Chairman Powell was insistent on continuing to tighten. The market fell 20%. He then changed his tone and the market bottomed. So yeah, it's pretty much usually the primary catalyst that stops becoming a problem, essentially, that allows the market to find its footing.
It's interesting, this focus on April 2nd. I was reading a note today from Henrietta Trace. She is a policy analyst, looks at DC stuff based at Veda Partners. And she said the problem is April 2nd, there's a possibility it might create more uncertainty because after all, yes, some of the tariffs are set to go into place. We might get some more announcements, but there's also a number of studies that are going to be going on, and there's some sort of extension of issues that could happen as of April 2nd. And it doesn't seem like that the market is sort of priced or prepared maybe for this to keep going. Is that right?
Yeah, what's crazy is that for the last few weeks and still today, there's really no one-day implied move in the market that is any greater than any other day over the next few weeks, which doesn't quite seem right because we know we're going to get a lot of information there yet. Markets are actually pricing in more volatility on payrolls a couple days later, or for the ISM the day before, which to me seems a bit off. So yeah, again, there's a lot of outcomes depending on what is said and what we learn and what any new information. So some of the information, just getting some clarity on some things could put, may not be a positive, but it at least could dampen uncertainty. Again, there's so many different variables that I agree that uncertainty, at least as measured by these indices, these policy uncertainty indices, may or may not peak that day. But unlike past periods where we had high uncertainty that usually collapses pretty quickly, I think we're in for a few months at a minimum of just elevated uncertainty going forward, because April 2nd is not going to be the last we hear of tariffs by any means.
So does that mean that if you're seeing areas of the market that you like right now, is it fair to just start nibbling ahead of April 2nd, or should you be waiting for maybe that potential big risk event to get more clarity on tariffs before you start kind of nibbling at some of the names that have been pretty significantly down over the last month at this point?
I mean, that really depends on everyone's investment style. In general, this year, the overarching view of ours before all of this tariff volatility started, we just recognized that we've had 2 years of big PE expansion, and credit spreads ended the year at the lowest levels in 25 years. So think of that as kind of fuel for further risk appetite. And we were at the lowest levels in 25 years. So the markets, had a huge appetite for risk in the last 2 years. And, now we kind of need to digest and see where the economy goes. And with this uncertainty perhaps persisting, I don't think this is the time to look for home runs and make big risk bets, particularly before April 2nd. I do think, maybe if there's really higher quality names that offer some stability, that's the type of stuff that we've been recommending in this volatile backdrop. And we think we're going to have quite a bit of volatility for much of this year between the longer term kind of part of the market cycle we're in and the extended uncertainty that we expect to last for much of this year around tariffs.
Well, and I guess if uncertainty is going to last for the foreseeable future, how do we trade during that? How does the market start to price in uncertainty or get used to uncertainty? Or is it just volatility, as you said, where it sort of just keeps bouncing around?
Well, think about the bond market. Think about the 10-year over the last year and a half. It's gone nowhere, and if you look at the 10-year, we've had, I count 7 narrative shifts on the macro outlook that we've rotated through since basically the end of 2022, where it was recession fear in 22, and then we went to no landing, and then we went to soft landing, and then recession. Then the Fed's going to hike, then they're not going to hike, and now we're back to potential recession fear. So I think that's what we're going to kind of go through in the market until we really have some clarity on the U.S. and global economic outlook, and certainly it starts with the policy from Trump. So we're not expecting the markets down tremendously this year, and that's going to, if it is, I think it's a wild card from tariffs. But we're expecting kind of a lot of narrative volatility, and certainly the last month and a half has been really negative. Perhaps things settle down over the next couple of months, and then something else pops up. But again, we still have pretty high expectations for earnings in the market. Valuations are still high. Credit spreads are off their lows, but still very low historically. So to me, there's not this massive amount of upside in this year, and I think there's a lot of uncertainty, and that means we're going to have a lot of shifts in the outlook as we have seen in the interest rate market over the last 2 years.
Michael, I'm curious where you feel like we're at in that economic data narrative versus how the market's sort of seeing it, right? Because we know the soft data has been very bad, right? It's been trending downward, of course, but the hard data, I mean, unemployment moved up, 0.1% last month. It's moving up a little bit, but I'm not sure we're seeing full labor market weakening there. Do we have room for more soft, hard data, and the markets will be able to accept that?
It's hard to say soft, hard data. But, I would expect to see softer, hard data, i.e., employment softening in April 4th. I think we get the employment report. But I also think that's expected, and I also think it's a function of uncertainty it's largely a function, again, that starting point of all this tariff uncertainty. So to the point where we perhaps see cooler heads prevail and some deals being made, and maybe that's a couple weeks away, maybe that's a few months away, there will be a point where that uncertainty peaks and comes down and the markets breathe a big sigh of relief. And we'll probably still see bad data thereafter, but that's the point in which the market tends to look through it. Similar to how the market looks through bad data 3, 4, 5 months after before a recession ends, when the market bottoms. So I think there's a high expectation of weak data, certainly until there's clarification on April 2nd at a minimum. I wouldn't expect much improvement in much of the data right now. But again, I think it's largely expected by investors, and so they're focusing really on what's going to happen in policy, because that's going to be the determinant whether or not it persists or we see a period of stability in the future.
That makes sense. All right, Michael, we got to leave it there. We should also mention the host of What's Next for Markets, podcast available everywhere. Check it out. I'm enjoying it myself.
Schaefer's a big fan.
I tell you, I've listened to it on my drive on Sunday. It's good. It's good. We're fans, Michael. We'll see you soon.
Appreciate it. All right. Take care.
All right, we're just getting started here on Market Domination. Coming up, we hear from one Nvidia analyst who's cutting his price target on the chip giant. Stick around, much more Market Domination still to come.
Nvidia in focus this week as the tech giant unveiled some new and updated chips during its annual GTC event. Let's bring in D.A. Davidson, head of technology research, Gil Loria, who has lowered his price target on Nvidia down to $125 from $135. Gil, I believe you were at the event this week. Just curious what you took out of the event and why you came out of the event and thought, maybe not much of a catalyst from what we learned.
Nvidia is making great progress on its product. It continues to roll out products that are far more powerful than the previous set, and that's helping them keep their technological edge. They're also doing a great amount to promote the whole AI ecosystem by partnering with anybody they can help develop new AI tools. So very positive takeaway on what Nvidia is able to accomplish. Having said that, we don't really have any better visibility into their ability to continue to grow at the rates that they're currently growing at. So they may grow as much as 50% this year, but next year, at best, they'll grow 20%, perhaps less than that, and they may decelerate further next year, maybe further after that. And it's very hard to have visibility into their growth in the out years when some of their largest customers like Microsoft and Amazon are starting to talk about their CapEx rates plateauing. On the price target, that's really more a function of where we are on market multiples. If all of the other mega caps are trading at a big discount to their historical multiples, or at least in the middle of the range of their historical multiples, we'd argue that Nvidia should be in the same boat in terms of its multiple, which is why we took the price target down.
So, Gil, I guess put another way, what would it take to get Nvidia shares to break back out? What information, what clarity, what new product, what would we need from them?
We need a clean handoff between their current largest customers and a new set of customers. So again, if Microsoft and Amazon are two of the top 3 or 4 customers, and Microsoft said a couple of quarters of flat CapEx and then slight smaller growth after that. Amazon said 4 quarters of flat CapEx. What Nvidia needs is another set of customers to pick up the slack. The potential for that is there. Between Stargate, Oracle ramping up, CoreWeave is going public next week. All that capital that's going to go to CoreWeave they're going to turn around and buy Nvidia chips. If there is a clean handoff and we see all those projects ramp up, that means Nvidia can sustain growth into next year. But that is very much up in the air, especially given the economic environment we're in. If CoreWeave can't do its IPO or can't leverage its IPO to borrow more money to buy more chips, then Nvidia may not have that clean handoff. That's what we'll be looking for in the next few weeks and months.
Well, and while you bring up CoreWeave, I also want to ask, reportedly it's looking at a lower valuation than it was originally reportedly looking at, Gil. And I wonder if that tells us something bigger about not just the private market, but the public market appetite for these huge, splashy AI investments right now.
It does, and that's if the deal happens. The deal may not even happen at these valuations, because what we learned about CoreWeave from their first filing was that Microsoft was a 62% customer, and then they have another 15% customer, which is either Nvidia or Meta. That's spillover demand from Microsoft, Meta, Nvidia. That not a type of revenue that investors typically want to put a very high multiple on. And that's one reason the multiple is down, but it's also the greater uncertainty. And in an economic crisis, debt financing may not be available for a company like that to continue to grow. And again, that makes their growth path a little less likely and possibly puts it at risk.
And Gil, finally, if I could, I want to switch gears and ask you about Apple, because there's a new report out today that the company is doing a sort of executive shakeup because of, again, reportedly Tim Cook's disappointment with how the AI rollout, or lack thereof, has been handled. I find this whole situation really interesting because I don't know how much Apple iPhone users are clamoring for this right now, but there seems to be a lot of disappointment internally about it. How important is this for Apple?
It's very important. The cadence for Apple is usually they get out on the Worldwide Developer Conference and talk about new functionality in June, and then they have that functionality rolled out in the new iPhone version when it comes out for the holidays. That didn't happen last year. We got a lot of very promising features at the Worldwide Developer Conference that got everybody very excited. And then we got very few of them out by the time the iPhone 16 came out. And we're still only seeing them come out very gradually. And Siri is one of the important ones. Siri is something that their consumers already use. And it's possibly the best interface for providing AI tools. So if Apple can't deliver that, if they can't deliver it for the iPhone 16 and maybe not even the iPhone 17, then something has to change. That's not the Apple way.
And do you think what needs to change is this executive shakeup? Do you think that'll help?
It better. Apple needs this upgrade cycle to sell more iPhones. They can't have flat iPhone sales and expect the stock to stay up where it is. That's why the stock is down the last few weeks, is the disappointment that the upgrade cycle continues to get pushed out. Now, to be fair to Apple, everybody's still going to buy an iPhone. And to your point, we don't even need those features. Those features will drive an upgrade cycle when they come out. By the way, some of those features are very compelling in terms of the photo editing, email summarization, prioritizations, notification prioritization. These features are already starting to be very helpful within our existing use of the phone, but they need to deliver on the full set of features for consumers to really notice it, give them credit, and get them that iPhone upgrade cycle that they need to get the stock going again.
Yeah, I don't know. I'm personally a thumbs down on the notification email summaries, but maybe that's just me, Gil. We'll talk about it next time, I'm sure. Good to see you. Thanks for your time.
Thank you.
Let's take a look now at some trending tickers. We're watching quantum computing stocks under pressure after comments at Nvidia's GTC conference, raising skepticism over the publicly traded companies in the industry, perhaps, and also the news that Nvidia is going to open its own quantum lab in Boston here. There's kind of an interesting dynamic between Nvidia and these companies, because Jensen Huang talked about quantum computing and said at one point it was 15, 20 years away. All of those stocks fell at the time. Now there's sort of now they're coming together a little bit.
Yeah, and I mean, I think what's interesting with these stocks, Julie, is just they're very early stage, I guess, is one way to sort of put them, right? Or they feel very early stage. And it doesn't quite feel like that market right now, where people are dipping their toes into very early stage things that are 15 to 20 years away. I mean, you do look, though, over the last 5 days, stocks have done pretty well. So to see them, there was up, D-Wave itself was up 25% over a 5-day period. Now it's down 20%. They're sort of just moving very aggressively, which I think is quite interesting. But I think overall, it seems like maybe if Nvidia is going to get into quantum, build out this lab, do they just end up owning that space? Is that kind of the next move here? And then the other quantum plays become a little bit less significant,
Or
right?
would their chips power the design of quantum computers is something that I've seen talked about here. I mean, the CEOs of these companies are at the GTC event, they're speaking, but it's not creating that sort of halo effect, at least not for now.
To me, it's an interesting piece of the Nvidia investor story too, right? We were just speaking with Gil Loria, and we were talking about sort of what's that next catalyst, and something 15, 20 years down the line feels like a faraway catalyst, but it is another sort of revolutionary source of growth that the company's starting to explore.
Yeah, but
and I
it's
wonder,
unclear.
what do you get excited about that at some point?
Yeah, it's unclear to me what their role would be. And of course, those companies pushed back and said, it's not 15, 20 years away. They say it's closer.
I got to learn a lot more about quantum computing.
I know, everybody does, I guess. All right, Nvidia-backed CoreWeave is seeking to raise as much as $2.7 billion in an initial public offering. That is a lower valuation than the $4 billion that Bloomberg reported last month before the downturn and volatility in the stock market. For more on what this signals about the public markets, let's get to Forge Global CEO Kelly Rodriguez. Thank you for being here, Kelly. Appreciate it. We just heard Gil Loria bring up the idea that maybe it won't even be $2.7 billion. Maybe when it actually comes to market, it could even be a lower valuation. What do you think are the prospects for that, and what do you think is going on here?
Well, we've watched this company for the last year, and they're the most disclosed AI company in the private market for sure. We upped the valuation from $19 billion last May to $29 billion in February. And in the recent disclosures, what you're seeing a company that in 3 years had revenue explode. So from a growth rate standpoint, we're waiting to watch the trend and see if it marks the opening of the IPO market.
Kelly, I'm curious, where do you feel like the market is at with the AI story, right? It felt like at least last year, or maybe even the last 2 years, you kind of had to have that AI pitch, whether you were actually a core AI company like CoreWeave is, or if you weren't a core AI company. Are we still in that sort of moment, or is that not really where the market's at with AI?
I think AI is still demonstrating, by virtue of the fact that they're 30% of the trading volume of the entire private market, that there's a lot of excitement about what it can mean. And certainly this being a core AI company, the one phenomenon that I will say is it's surprising given the fact that the amount of capital that you can raise in the big core AI firms appears to be unstoppable. If you look at what happened in the most recent Databricks raise, what that said to me and many market watchers is why go public when you've got access to that kind of capital privately. So this is one that we're carefully watching, but the disclosed numbers look pretty impressive.
Well, what's the answer to that question in the case of a CoreWeave? Why go public then?
I'm not sure. Actually, I think a lot of us are watching it and scratching our head.
I mean, especially if it is at that lower valuation than there initially was reported, and especially given the public market volatility that we're seeing. Does it signal that maybe there is a little difficulty on the private side raising as well?
It could. We're not seeing that across the board. So unless there's something unique here. The one comment I would make is, since they are an infrastructure play, I mean, in my view of software and the applications of AI, this seems like the kind of company that the public investor will understand based on what its application is. I mean, this is fueling the infrastructure for AI in other companies. So it's a real core enabling technology in some ways.
And I'm curious, we've seen this pretty big drawdown in the public markets in a lot of these AI names over the last month, right? How long does that have to extend for then AI companies to say, I don't really know if I like how the public market is treating AI-specific stocks?
Well, I already think that it's surprising that you'd find an AI name interested in going public right now, generally. So I think the level of capital that the big names have gotten, and last time I was here, Josh, I was talking to you about the private Mag 7, and we've got 2 or 3 big AI names in there, and all of them have incredible access to private capital. So I don't see any of those going public anytime soon.
I want to ask about Klarna also, which is not a direct AI name. It's a buy now, pay later, but they use a lot of AI. Certainly, it's helped keep their head count down. The CEO has been very open about that. Reportedly, maybe exploring an IPO in April in terms of the timing. That one, like CoreWeave, perhaps, is something that people can wrap their hands around, right? They understand what Klarna does because many people interact with it. How do you think the reception for that one is going to be? And that's one that's like, they were going to come public, they weren't. They've been back and forth a lot.
They've demonstrated a lot of discipline in the last years. I think a bunch of people who've been watching it see it as trying to ready themselves to be IPO ready. I think what we're seeing right now is a real question of whether the IPO market is open or not. And I'd say my answer to Klarna would be they'll watch CoreWeave and see how it goes. Because given the velocity coming out of last year, people thought the IPO market would start to open, given the macro trends and tariffs and everything else. People are really waiting for that one to go. And Service Titan looked good earlier, if you watched that. And now I'd say in the last few weeks, CoreWeave is really the one name to watch to see if it opens it up for other people.
So do we need that sort of policy uncertainty to clear then to get that opening of the IPO market that we all it felt like we were talking a lot about coming into 2025?
It's an interesting chicken and egg question. That's why I think an AI company being the one to be the next big IPO would be a really interesting statement to the market. But I think ironically, it won't mean you should see AI companies going public anytime soon. I think you'll see fintechs and potentially other sectors, such as Klarna, say, okay, they got treated pretty fairly coming out, we'll give it a shot. But I think everyone's watching and waiting. All right,
a trend we'll keep watching too. Appreciate you joining us, Kelly.
Thank you.
Thank you, guys.
Stick around, much more market domination still to come.
Now let's get to a call of the day. Citi is upgrading Boston Beer from neutral to buy. The note highlighting a clearer path ahead after volatile marketing campaigns for its different brands. And today I learned that there is something called Sun Cruiser. Mr. Schaefer has educated me on this. I'm not a big drinker for the audience, but Sun Cruiser is a canned cocktail that has been doing well for
it's like Arnold Palmer in a can, right? It's iced tea with vodka and it's mixed and it's a ready-to-drink cocktail. And I think what we were talking about earlier, Julie, was I was talking about the whole Truly story with Boston Beer Company, right? When you zoom out on this stock and look at a 5-year Boston Beer Company stock, it used to be $1,000 a share, and it's come way down. And why did the stock come down? Because they tried to get out of beer, or I should say grow out of beer into other products before. Truly was doing really well, those hard seltzers like a White Claw. And then High Noons came around and ready-to-drink cocktails came around, and Boston Beer didn't really have that product. It seems like Sun Cruiser is maybe that product for them right now. It will be interesting to see sort of how it grows, right? Because I think the hard part of this industry is it felt like White Claws and Trulies were the new beer for, 2 summers.
Yeah.
And then all of a sudden they just disappear and everyone drinks High Noons instead. And then now there's Sun Cruisers and there's Surfside.
There's all these. What's next?
There's all these different drinks, Julie. I don't know. If we had that answer, we'd be making them.
I guess we would, wouldn't we?
Right?
Yeah, good question.
We're gonna find out, Julie.
I'm sure you'll be doing a lot of market research this summer.
Yes, I will do some market research and we'll do some taste tests. How about that?
Okay, I like it.
All right, President Trump's policies decisions spurring up a lot of uncertainty and bringing to light several risks for the Trump economy. Yahoo Finance's senior columnist Rick Newman joins us now to discuss. Rick, you're creating a list here essentially of what could go wrong next with the Trump economy.
Yeah.
What's at the top of the list? What do we got on
Okay,
here?
backtrack for a second. Next time you guys have me on set and you're talking about cocktails, you need to have a couple on ice, and we're going to sample them,
taste
okay?
test.
Now
All
I'm
right.
thirsty.
You're invited to the taste
I
test
think that
next
has
time,
to be
Rick.
Friday afternoon show.
Okay, so what could go wrong next in the Trump economy? Everybody's getting tired of hearing about this, and the markets want to be optimistic. Surely all this chaos will pass, maybe not. There's a bunch of stuff, and I'm not making this up. I'm looking at all the analyst notes, what the economists are saying, talking to people, what are they worried about? First of all, these reciprocal tariffs that are supposedly coming on April 2nd. Everybody has tariff fatigue. Nobody wants to think about this anymore. But these are potentially going to be a bigger set of tariffs than we've already seen before. Possibly, markets are possibly not ready for what's coming. This thing with firing 2 Democratic commissioners at the Federal Trade Commission has generated concern that this is just a tryout to see if Trump can do this at the Federal Reserve. So this is going to work its way through the courts. Probably the courts, including the Supreme Court, are going to say, no, you can't do that. You don't have the right to fire anybody until their commission's over. You can replace them. But is Trump paying attention to what the courts say? We're not even clear about that. We're seeing a lot of talk about, guidance for investors. Get out of the U.S. market, including foreign investors. I mean, there are a lot of foreign investors who have been investing in U.S. stocks for the last several years for obvious reasons. United States stocks always outperform. Not now. We're seeing a lot of talk about an actual rotation into European stocks, Chinese market, stuff like this. There are others, and I'll put together a coherent list that anybody can find on the site soon, I hope. But this, it's not necessarily getting better anytime soon.
And the market doesn't seem to have priced in. I mean, the market obviously has priced in some negative outcomes as a result of all this, because we've seen stocks in correction, but maybe hasn't priced in the extent of what you're talking about.
No, but I mean, obviously nobody knows. I mean, we're off the floor from that correction. So, investors, it seems to me, the way I feel the market is investors really want to think that Donald Trump is going to be good for risk assets and good for the economy. It has not happened so far, and it's clear at this point that markets completely underestimated what Trump was going to do on tariffs and trade wars. Okay, so now I'm seeing some analysis still saying, well, we're going to get more certainty at some point. A lot of this is still, it's just used as leverage. And then once Trump gets whatever fill in the blank thing he wants from Mexico, China, Canada, Liechtenstein, whoever he's going after next, then he's going to pull back on the tariffs. I just am not sure that is really going to happen. And that, Trump is saying he's not pulling back on tariffs. And he is sending his spokesmodels out, Lutnick, Bessent, to basically say the same thing. This could very well just be a permanently more punishing trade environment, at least for as long as Donald Trump is in office. That in itself would not necessarily cause a recession, but at some point, what's the tipping point here? I mean, nobody knows, and this is what we're talking about on air all the time, right? Yeah. Like, how far is this going to go? I just think there's still a lot of risk there.
Maybe thousands of workers going into a labor market with a historically low hiring rate.
Okay,
could potentially cause an issue
so we know about the federal layoffs.
Yeah.
There are now some Wall Street layoffs. Nobody cares about Wall Street layoffs because it's a bunch of rich people who get giant severance packages. But that indicates a slowdown in the sort of financial economy. There's talk now among the auto workers unions that they're expecting layoffs because just slower production. You can't do this. I mean, the U.S. economy is remarkably strong in general, but you can't do this forever and say the U.S. economy will always fight off a recession. At some point, it won't.
Yeah, Rick, thank you.
Bye, guys.
Appreciate it. Well, sales of previously owned homes in the U.S. rebounded unexpectedly in February. There's a good economic data point. They advanced 4.2% from the prior month. That was well above analyst estimates for a 3.2% decline in sales. Joining us now, Mike Frattantoni, Mortgage Bankers Association chief economist. Mike, to what did you attribute that better than expected reading on existing home sales? Do you think anything fundamentally changed? Was it a one-off? How are you framing that?
Yeah, so our clearest read into the market is our own data looking at the pace of mortgage applications each week. And if you look at the applications to buy a home, they were running about 6% ahead of last year's pace. So in line with that existing home sales number. I think you really have two factors that are more positive in the market right now. One, mortgage rates are trading towards the lower end of their recent range. We're 6.5 or so, and lower than that for an FHA loan. A lot of first-time home buyers in the market taking advantage of those FHA loans. The second factor, and this was very clear in that existing home sales report, inventory's up. That has been the major constraint on the market the past couple of years, is this there weren't enough homes for sale. The lock-in effect really kept many owners from listing their properties, but existing inventory up about 20%. You got about 9 months of new home supply on the market as well. So for those looking to buy this spring, again, mortgage rates are at the lower end of their recent range, and there are homes available to look for.
Mike, we were just talking a lot about sort of the uncertainty around what President Trump is doing with tariffs and really policy overall, right? I was interested the other day, home builder confidence came out, hit a 7-month low. They cited tariffs, right, and sort of overall uncertainty. How does that weigh on the housing market specifically? What is Trump uncertainty doing to the housing sector?
Yeah, I think for a home builder, it's very direct, right? Because we import a lot of our lumber from Canada. And so tariffs on Canadian lumber directly add to the cost of that new construction home. But, new home is only a part of the market. In the existing market, again, we've seen this lock-in effect where homeowners who got a 3% mortgage in the middle of the pandemic had just been reluctant to list their property. Now I think more and more life events are accumulating. People are getting married, having kids, getting new jobs, and they're moving. And that's leading to this increase in inventory. And for home buyers, that is a real positive, because it's not the multiple offers above list price that we've seen the past couple of years. Now the buyer has a little more negotiating leverage. Totally would agree that more uncertainty in the environment usually makes both households and businesses just a little more cautious generally. So getting some of this uncertainty resolved will be helpful. But I think home buyer sentiment in the wake of lower mortgage rates and more inventory is going to be more positive.
And Mike, we tend to think of the housing market as a lagging indicator, right? So even if there was an economic downturn that's caused in part by the sentiment around this uncertainty, how long might it take to actually show up in the housing market if that was going to happen?
Yeah. Well, again, it's the two sides of the coin here. A softening job market is certainly not good in terms of buyer sentiment, but a slower growth economy and all of this uncertainty that we're talking about has brought rates down to the lower end of the range. And, per Chair Powell's comments yesterday, has them leaning more towards 2 cuts this year rather than 1 or no cuts as we were thinking of as recently as January. So the lower rates clearly are a benefit. The softer economy clearly is a headwind. And the net we're just sort of seeing week by week, month by month in terms of the data. But we could not have asked for a better time for rates to drop than at the beginning of the spring home buying season.
Mike, good to see you. Thanks for joining us.
Thank you.
Coming up, we'll check in on the state of the EV market as one Tesla analyst is remaining bullish on the stock. Stick around, much more market domination still to come.
Tesla share is under pressure again today. Analysts continuing to sour on the stock. Piper Sandler lowering its price target in a new note today. And even longtime Tesla bull Dan Ives is wavering, saying the company is in a, quote, brand tornado crisis moment. Yahoo Finance senior autos reporter Pras Subramanian is plugged into all of this. Pras, Dan Ives coming out and essentially saying it seemed Mr. Musk needs to walk away from some of the government efficiency stuff and get back to Tesla. Was that sort of the read-through on what Ives is arguing here?
Yeah, he's asking for a change, a course correction, changing course here at Tesla, basically asking for Musk to step up and be back at the company and kind of split his time at Doge, basically asking for, 2 things, right? One, really kind of formally announce what his sort of role is going to be in terms of time spent at Tesla and Doge, make it so that the investors are aware of how much time he actually is going to be at the company and also at the White House. Secondly, also, they want to see a roadmap. They want to see a roadmap for when those cheap EVs that we've heard a long time ago, when they're going to come out, wants to know exactly what's the actual plan for those cheap EVs, and also more on the robotaxi testing in Austin, also part of that equation. But he seems to think that if these things are clarified, damage might be limited to just Q1. I think that's a big if in terms of how much they can actually fix or how much Musk can actually fix now for in the rest of the year.
And Piper also coming out with a note on the stock, right?
Yeah. I think our Brian Sazzi wrote about that, talking about how he lowered the price target, I believe, but also
Yes, there
upgraded
was a
stock.
down-
And all this sort of happening while they're recalling Cybertruck.
Exactly.
Like there's just, it seems like there's not a lot of good news happening right now in Tesla.
Yeah. I mean, the Cybertruck recall, 46,000 trucks recalled there because of a trim piece might fly off when the car's moving. Incidentally, that also lets us know there's 46,000 Cybertrucks in the wild out there in the U.S. Since sales began late 2023 and 2024. But interesting that it's the 8th recall for that vehicle. I mean, that's a lot in the last year and a half, and it kind of goes to show you where that model is. Can you repair the demand destruction that's happening with that vehicle, or is it just sort of a dud at this point?
Yeah, and it seems like also that the Cybertrucks are the ones that are sort of getting the most visible ire from protesters and such, versus just the Model Ys and
I thought they were a bulletproof truck. How do you have a recall on a bulletproof truck? I thought the whole thing was like it doesn't break. It's
well, you're not
indestructible.
shooting things into it. There are things falling off of it, you see.
Oh, I see. That's not good for a
stronger
car.
glue and epoxies, I think.
Sure.
I guess so. All right, thanks, Prash. Appreciate it. All right, shifting gears now. Let's say you do want to invest in the auto industry, but you don't want to invest in Tesla because of what's going on with that stock down more than 40% to start the year. There are, of course, other auto stocks outside of the EV maker, particularly perhaps in auto tech. We're navigating how to play the auto sector with the Yahoo Finance playbook. And joining us now on set, Emmanuel Rosner, Managing Director and Senior Analyst of Autos, Parts, and Auto Technology at Wolfe Research. And it's so good to see you in person. Thanks for being here.
Thanks for having me.
So when we look at the other actual automakers, we'll get to auto tech in a moment here. You obviously have Tesla, which we'll leave to the side for a moment. You've got GM, you've got Ford. And I don't think you're an enthusiastic buyer of any of the OEMs or the traditional car makers, right?
That's fair. It's a very tricky time to invest in autos right now because you have that threat of tariffs. This is something that has the potential to throw a complete wrench into the auto sector. $200 billion of autos come into the US every single year, whether it's auto or auto parts. You put a 25% tariffs on it, in Mexico and Canada, that's a $50 billion headwind. You would wipe out a lot of the earnings from these automakers. So right now we're very much in the wait and see mode. April 2nd is a big, big day. We'll find out what kind of tariff we're talking about. Assuming these are manageable, we would be more constructive. But right now, it's truly something that is existential, and it's hard to overstate that.
Well, to that point, where do you feel like we're at as far as sort of how these stocks have acted? Right, GM and Ford have both moved a lot on tariff news. Where are we sort of priced there in terms of, are we priced for 25% tariffs on Mexico and Canada, or if we get those full tariffs, is there a lot more downside to these names?
It's a great question. On the one hand, there's very large overhang on these stocks, so they're not going anywhere. No one wants to really own them ahead of some clarity on this. On the other hand, it's not possible to argue that it prices in a high probability of them, because let me give you some numbers, right? For example, GM guided for about $16 billion of EBIT this year. If there were tariffs of 25% on Canada and Mexico, that would hurt them potentially by $12 billion. You haven't seen that kind of move. For Ford, for Stellantis, it would wipe out the entire earnings or potentially the entire free cash flow. So this is not what's in the stock. The potential for tariff is so damaging for the autos that basically the market has said, look, this is so bad, let's assume it's not going to happen. But at the same time, they're also not buying these stocks. So what we're looking for is clarity. How bad is it? Is it really bad? And potentially a removal of overhang before really going in. But if we get those things on April 2nd or later, and the overhang is removed, then I think that creates some really interesting opportunities, and we could definitely speak about that.
Yeah, let's speak about that, because on the other hand, what about the demand picture? It's not like this is an amazing blockbuster car demand picture either, right?
It's autos demand is very much hanged in there in the US, so we've been running it in the 16s basically last year. It's this month, the month of March, despite all these headlines that we're hearing on the consumer, probably going to be another 16 million type of month. So we haven't really seen the weakness yet in terms of autos demand. Now, if we do get tariffs, the cars would be probably $3,000-$4,000 more expensive on average. The consumer could still potentially weaken, and you may even have a payback if there are some consumers that are pre-buying now ahead of tariffs. You would have that payback. So it could very much weaken very quickly, starting post-tariff. But as of now, we haven't really seen it.
So we said we didn't want to talk about Tesla specifically, right? But someone that buys Tesla is usually probably interested in sort of the technology aspect of the auto industry, right? Are there other names available that get into the technology of the auto industry? Maybe they aren't making the cars, but they're sort of providing that maybe
Right.
tech investor
And maybe
side of the
without
trade.
the Tesla baggage.
Right.
Yes. All right. So we can speak about Mobileye.
Yeah.
Mobileye is a name that we like. It's essentially a technology supplier that makes software for autonomous driving. They provide complete solution to legacy automakers that are not called Tesla. How could they offer autonomous cars, essentially? And they offer a system that go anywhere from like semi-autonomy to full autonomy to potential robotaxi. Now, the stock has been under dramatic amount of pressure in the last few years or so. Part of it is because they need customers and these automakers to sign up and actually buy their product. And a lot of these automakers have been sitting on their hands and they haven't really made any sourcing decisions. So what we like it here is, look, it's had a lot of pressure. Seems a lot is priced into the stock. If these guys this year can announce some legit automakers signing them up for autonomous driving, you have tremendous amount of upside. And it could be Nissan, Honda, Toyota. It could really be some legitimate automakers, but it needs to happen to validate the story.
And the two other stocks that you have outperforms on, I believe, are Autoliv, and Aptiv, which
Yep.
are sort of in the car building ecosystem.
Yep.
Where do they fit in, and why are they not as vulnerable as some of the other stocks that you look at?
No, so generally speaking, it's all assuming tariff is manageable. So it's on the other side of it. But what we do like about names like Autoliv and Aptiv, they are somewhat higher tech. Aptiv is focused on electrification as well as active safety. Autoliv makes airbags. What we like about them is, first of all, there's quite a bit of secular growth, which is not just waiting for people to buy cars. There's more and more of their content in the cars. These guys are also aggressively taking out cost, especially Autoliv. They're reducing headcount pretty dramatically. And what we like, especially in the case of Autoliv, is all that free cash flow. They're aggressively buying back the stock, so returning it to shareholders. This is essentially a good recipe for strong free cash flow and strong earnings growth as well.
Manuel, I want to come back to something you said a minute ago. You talked about sort of the traditional automakers getting into autonomous driving. And part of me wonders, does Tesla have to succeed first to make these companies move, right? If I'm Ford or GM, I get why they'd want to get into it, but would that be sort of the catalyst that really expedites that industry growing within autos?
Yeah, no, it's a potential catalyst. The fact, if Tesla is successful at it, and by successful we don't mean that the technology works, but they can actually turn it into a real business where there would be a higher take rates of people paying for FSD. Other automakers would basically be looking at it and say, look, I'm going to invest in it because it's actually a real business line. Part of the issue with Tesla is the technology works quite well, but the take rates remain really, really low, which means people do not want to pay $100 a month for FSD because it's not useful enough for that kind of price. So we need to see that, and I think we're starting to see it. Tesla is obviously offering a promising robotaxi starting in June in Austin. If that is successful, other automakers will take notice for sure. We think it could be good for Mobileye.
Emmanuel, thank you so much. Good
Thanks
to see
for having
you.
me.
Appreciate
Good to see
it.
you.
And while we're wrapping up today's market domination, don't go anywhere. We got you covered with all the action following the closing bell, including the latest earnings results from Micron, Nike, and FedEx. Stay tuned for market domination overtime.